Everybody, and welcome to the lecture on financial statements. Okay, so financial statements you all might be thinking is not really worthwhile or not something that is applicable to your business or your line, and to a large extent you will be correct in thinking this because you will all employ proper accountants, CAs and auditors to draft these financial statements for you and to be able to assist in your tax matters. However, financial statements, I believe, will be of importance to you in terms of rendering a better service to your clients. Because if you can understand financial statements and your client comes to you with a liquidation or corporate matter or anything like that, and you get hold of the client's financial statements, you will be able to better analyze and give advice to your clients based on those financials. You might then be able to see that that company is not liquid or not savable, and there's no use to even try and get a court order against them. So it's more for review purposes, also for your own business. Although your auditors and accountants will draft these financial statements for you, it will be important for you to understand what it says, what it means. You'll have questions and you'll be able to have a better overview of your business by understanding financial statements. Okay, so I'm first going to share our little PowerPoint. There's not much in there. So basically, I just wanted to show you guys. So from the ledgers, we did a whole lecture on general ledgers. Now from those ledgers, we will compile a trial balance. Now trial balance will look like the one on the screen. So it's simply a summary of all of our accounts and whether they closed on a debit or a credit balance. And at the end, the purpose of our trial balance is to see whether we have entered a debit entry for each and every credit entry. So those debits and credits must match up. But now at this point, if you look at this trial balance, if I ask you, what is this company solvent? What is their profit? What is their revenue? It will be difficult to determine directly from this list. So from here, we want to enter these transactions into a proper set of annual financial statements, which is compiled of a balance sheet and an income statement. Okay, so let's have a look what the aspects are that we have in our financial statement. So firstly, we'll have an income statement, and that's rather self-explanatory. The income statement will consist of income and expenses. So income statement gives us a history of how we got to this point. So it tells us we made this much revenue and we've incurred that much expenses, and up to today, this is the profit that we have. Now the balance sheet will consist of the following. So under assets, we have to split between non-current assets and current assets, so that the users of my financial statements can see whether your business is liquid or not. If it just shows assets and that asset contains or is only a building and you want to do an application for finance, the bank won't give that to you because they're going to say, how are you going to pay for the building because you don't have any money in the bank? So it's important to see what's non-current assets are long-term assets and what is current assets. So non-current asset is any asset that we can use for more than 12 months, or that we'll receive the advantage from for more than 12 months. Okay, then under equity, we've got capital. So our initial shares that we buy into the business, initial monies that we put in, that will be shown as capital. And we'll have retained earnings. Now, retained earnings is basically a history of all of our net profits from previous years. So the moment so every year you will have an income statement. That income statement, the profit and the loss, when you run year end on your accounting system, it moves the profit from your income and expenses into your retained earnings. So if your business is 10 years old, the net effect of 10 years profits and losses will be the balance of your retained earnings. And then we have liabilities. So as we defined it when we did general ledgers, liability will be a future outflow of economic benefits, And there we also have to split between non-current and current so that we can see what is due and payable in the next month or two or the next 12 months, and which liabilities we only have to settle in a longer period of time. So the balance sheet basically tells us what will happen in future. So that means the balance sheet will tell us who will pay me money in terms of clients. Who do I have to pay in future? What car will I be able to use in the future? Okay, so that's not the book defined definition of an income statement and a balance sheet, but I think you will have some more value in understanding that the income statement tells us how we got here. The balance sheet will tell us what will happen. Okay, so now this is actually quite a important one. Basic tests to do to avoid fraud. Okay, so in my line of business, being a legal accountant, we've come across, helped to a certain extent, suffered some of our clients some big financial losses and had to have some big fights with the LPC because of fraud. So some very, very basic checks that you have to do. So in most cases, if you've got a clever accountant and they hide the fraud properly, it will be very difficult for you or even your auditors to pick up that there is fraud in your business or money is going missing. However, in many of the cases that we've worked on and helped with, if the attorney did some of the most basic checks in the world, it is so obvious that something is not right in that set of books. So this list here is more in the lines of, this is the very, very obvious things, but it will help to mitigate the risk of fraud in your business. Okay, so the first question, does your trust assets agree to your trust liabilities? So this is very simple. As at today or as at the last month end, go and take your trust assets and go check what you've got in the bank. Ask your accountant to give you a list of trust creditors. If they agree, then you are relatively safe in terms of that test. If they don't agree, something is materially wrong in your accounting records. Even if your trust creditors are less, so it shows that you've got a trust surplus, that's also wrong. Those two must agree 100%. Okay, then in the previous bank recon lecture, I told you guys, inspect your bank recon for transactions increasing the cash book balance. In other words, our trust assets are short. I've got more liabilities than what I've got assets. So then the accountants will load receipts against the bank. So they show on the cash book and they lift your cash book balance to look as if it's the same as the liabilities. But it shows as a reconciling item because it never actually agrees to the bank statement, or it never goes through on the bank statement. No one ever pays that money in. So long outstanding receipts on your bank recon is a big reason for concern. Okay, then trust creditors with debit closing balances. That means you've got payments were made out of clients' files and those clients did not have monies on trust. So it could be that you made a mistake, but then in any case, it's important to check that, because if you have trust debit balances on your year-end reports, then that would be a qualified audit opinion that goes to the Law Society. Your auditor has to report you to the Law Society. So that is a big issue. And also, if your accountants were stealing money from your trust account, then at a stage they were going to run out of matter balances or credit matter balances, and they will have to have debits to balance the bank statement. So trust creditors with debit closing balances, big issue. Then journals. Journals are a big one, or a big risk, where the accountants move monies around between files. So if they steal money from a specific file, now the file concludes, the file balance goes down to 0, and now suddenly they're sitting with a shortfall on the file. So then they'll take a journal and move monies from another file which has got available funds and top up the current file where they stole the money from, and then they'll continue rolling that. And they can do that for as long as new monies keep coming into your trust account. So that's also a very big risk. So any accounting program can give you a report of journal batches that was posted, and it's very important to go and double check those journals. Okay, then also split transactions. So where monies came in and it's supposed to go to one file, but they split it across a number of files to make up for files where they've stolen money from. Then number 6, I've put live customer statements, because if you set your accounting program every month to send out live statements to clients, the quickest way to pick up that someone's money is missing from your trust account is to send them a statement, because your client will very, very quickly pick up the phone and call you and say, no, I've got 100,000 Rand in your trust account. Why is it only showing 50,000 on my statement? So that kind of mitigates the risk that your accountant can move monies around between matters, because then the clients are going to shout, not understand what the journals are for. So it's very good practice to have live customer statements going out from your system. And then supplier reconciliations. What a lot of accountants will do is they will make payments to suppliers, but what they'll do is they'll change the banking details to their own, but they do it per client, per supplier. So you do 1 year, 1 there, 1 there. So no supplier actually picks up to you or moans really, because you only steal a little bit here. So what they'll do is they will make a payment to a supplier, but put their own bank details, but put all the supplier references. So now the supplier comes back and says, listen, you guys haven't paid me for this invoice. Your accountant goes to you with a bank statement and they say, look, yeah, we've made the payment, all the references are there. But in the meantime, that money went to their own pocket. So it's very important that every month you see a reconciliation between a supplier statement and their own and your accounting records. And then also, I must actually add that as a point there, is access to loading new suppliers and changing supplier details on internet banking. That's a very important function that at least 2 people and possibly you as the owner also must authorize before someone can do, because it's very easy to go and change those banking details to their own. Okay, but that's just some basic stuff to check and make sure that those things are in place to help you mitigate the risk of fraud in your business. Right, now again, a little class example on financial statements. Right, so we are in the year 2025. I have given you a trial balance. In other words, this is just a list of all of my general ledger accounts in alphabetical order and whether they closed on a debit or a credit. Now the exercise will be, so let's firstly check. So these are template. So we've got a balance sheet. Now balance sheet, we've got some non-current assets and some current assets. We've got our equity, which is retained earnings. We've got liability split between non-current and current. And we've got a income statement. Income statement shows our income, our expenses, and whether we have made a profit or a loss at the end. So this is basically the little template that we use for balance sheets and income statements. So the exercise that we're going to do is we're going to simply take each account and we are going to slot it into either the balance sheet or the income statement. Now what I've done is I've put one of our little templates that we did right in the beginning in the general ledger lecture on the side here, which will help us. So now we know if a account has a debit balance, it's either asset or expense. So I just need to go and see which ones are assets, which ones are expenses. And if it's on the credit side, it means it's either a liability or income. Right, so let's start with the first one. Bank charges with a debit balance of 4,000 Rand. So that means we are either looking at an expense or an asset. So let's ask ourselves, the bank charges that go off my account every month, will the bank give it back to me? The answer is no. So then it can't be an asset. It's not future monies that's going to come back to me. So it's got to be an expense. And the expenses, I'll have a line item for bank charges, 4,000 Rand. And if that's the only transaction that we've had, we now have a loss of 4,000 Rand. Okay. The next one, the business bank account. Now the business bank account, you see, has a credit balance of 5,023 Rand. That means it's either a liability or income. So what does that mean? That means my bank account is actually in overdraft. So now we've got to ask ourselves, will we have to repay that overdraft in future? Then it's a liability. Or if the bank tells us, no, it's fine, don't worry about it, then it's income. So in this case, most probably we're going to have to repay the funds. So my business bank account, if it's got a credit closing balance, will be a liability. Now the question is it non-current or current? Will the bank tell you, don't worry about the overdraft, you only have to repay it in more than a year's time? No, every month they take your little chunk of the overdraft. So and the current liabilities, I'm going to say business bank account, 5,023. Okay, now we've got a shareholder loan, and I put a note there to say it's not payable in the next 12 months. So this means this is money that the shareholder, remember I'm the business, I'm a separate entity, and now the shareholder has borrowed me 10,000 Rand, which I can use to start up as the business. So it's a credit balance, which means it's either a liability or income. Now, if it's repayable to the shareholder, it means in future I will have to, me as the business, will have to give this money back to the shareholder. And in that case, it's going to be a liability. Now, is it current or non-current? So to avoid confusion, I specifically put there not payable in the next 12 months. So that means I have a non-current liability. It's only payable in more than 12 months. Shareholder loan, 10,000 Rand. Right. Next one, cash on hand. So that means it's the physical little petty cash box that's at the receptionist where you go if you want to go and buy your KFC and McDonald's from. So cash on hand's got a debit balance. So that means it's either asset or an expense. Now let's see, cash on hand. Will I, as the shareholder, receive future value from that? And the answer is yes. If I close the business today, I can physically take that money and use it for myself. So that means it's an asset. It's not an expense. It's not something that's gone and can never be used in future. I can in future use that cash. So that means it's an asset. Now do we decide, is it non-current or current? Petty cash box, the value there will typically move. You'll have monies in and out of petty cash the whole time. So the moment it's a trading account, we'll show it as a current asset. Cash on hand. 063. Right. The next one says cell phone expense. It's got a debit balance, so it means we're on the debit side there, and it's either an asset or an expense. Now, by using the word cell phone expense, that means it's my monthly usage charge in terms of my contract, and that's what I pay for the minutes. Now, after I've used all of my minutes, will I receive future value from that cell phone? Well, from that payment? And the answer is no. Then the money is gone. So cell phone expenses will be my income statement under expenses. And you will see cell phone 3,000 Rand. If you change the wording there and I said cell phone handset, iPhone 12 or whatever, and put a value next to that, how would that affect the transaction? Now it's no longer expense. It's not the usage. Now I'm talking about the actual handset. How long will you use your handset for? And the answer is 2 years, because in 2 years you'll upgrade your contract and you'll get a new phone. So that means if that said cell phone handset, then I would have a non-current asset saying iPhone 12, for 3,000 Rand because it is something that I will be able to use for more than 12 months. Okay, so that's just to explain, but in this case, it's a cell phone expense, 3,000 Rand. The next one, computer equipment. So this means this is your laptop or your desktop PC or something like that. It's a debit balance, so it's either asset or expense. Now, if I go and I buy a PC, well, is that PC gone and lost in the month where I buy it? The answer is no. I will be able to use that PC for a number of years. And because I can use the PC for a number of years, that will be a non-current asset. So, computer equipment, you can put there as 10,000 Rand. Right. Now, installment sale creditor. So this means this is the guy, you can see this is linked to the account below that, which is the motor vehicle. So this means I went and I bought a motor vehicle to the value of 30,000 Rand, but I financed the total amount. So it means in future, I will have to repay that installment sale creditor. It's a credit balance. So it means it's either a liability or income. So if it's a liability, I'm in the liability section, and now over how long period will I repay my car? So if the answer is if you only finance the car over 12 months, which is highly unlikely, then you would show your installment sale creditor as a current liability. But in general, we'll finance cars for 5 or 6 years. So in that case, it's a long-term liability. So under non-current liabilities, I'm going to say installment sale creditor, and the value there is 30,000 Rand. Now, same with the motor vehicle. The motor vehicle, I don't use the whole motor vehicle and in 1 month and next month it's not working or it's used up. I will use it for a number of years. So for that reason, the motor vehicle will be a non-current asset, and the value is 30,000 Rand. Right. Now we've got printing and stationery. So this is small things like your rulers and paper and pens and that. In general, we'll go and buy a pencil or a ruler or staplers that, and we will use all of that in the next month. So pencils and that we don't show as long-term assets. It's not something that we do. If you, however, go and you buy a Montblanc pen of 40,000 Rand, that you can show as a non-current asset because that pen you will most probably use for 9 or 10 years. But in general, printing and stationery is the paper and the everyday consumables. So it's an asset, it's a debit side, so it's either asset or expense. Now, as I explained, we don't have long-term value out of it. So I'm merely going to expense printing and stationery that I purchase. Okay, now we've got professional fees. So this is now for the work that we've done. So we've done work to the value of 50,000 Rand. It's a credit entry, so it's liability or it's income. Now, when my clients pay me for work that I've done, will I have to give the money back to them? The answer is no. Then it would have been a liability. But the answer is no, I can keep it. Because I can keep the money, professional fees will be shown as income. And now suddenly we've changed to a profit. So the formula there is simply income less expenses, and we'll see how that moves as we move along. Okay, now we get to the next two. Let's look at these two combined again, rent expense and rent deposit. So rent expense will be for my usage of my office. Once I pay for the month and I get to the end of the month, will the landlord give my rent back to me? No, it's a debit entry. So it means rental, the expense is a expense, and we should reflect that under the income statement. So 7,000 Rand. The rental deposit is also a debit balance of 7,000 Rand. So is that an asset or an expense? Will I in future receive that rental deposit back from the landlord? And in all likelihood, yes. So then it's not an expense, it's an asset. In future, I will receive money for it. Now, there's always a debate about the rental deposit. Is it current or non-current? In practice, we'll always show a rental deposit as a current asset. Okay, the reason for that is there will be a penalty clause or whatever, but we can get out of our lease agreement. So because we can get out of our lease agreement, we'll show that rental deposit as a current asset. If it needs be, we can get that deposit back in less than 12 months. Okay, we always in practice want to show your, now I entered that under current liabilities. Whoa, let's go back, sorry. Current assets, rental deposit, 7,000 Rand. Okay, that's a current asset. Okay, we always try and show current assets as high as possible. That is what makes businesses strong and liquid. So we want to try and use the act to our advantage so that we can show that as big as possible. We want to show as much cash, as much short-term assets as possible to be able to get finance. Okay, next one, salaries. So it's a debit balance, means it's either asset or expense. After I've paid my employees, will they give the money back to me? No. So salaries and wages will definitely be an expense in the income statement. Then we've got business creditor ABC stationers. So this means I've got ABC stationers. They've delivered stationery for me, and I now owe them the money for this stationery. So it's a credit balance, means it's either a liability or income. Will I in future have to pay ABC stationers? And the answer is yes, most definitely. Now, when do I have to settle my stationery account? If the guys say, no, settle it next year, then you can show it as a non-current liability. But in this case, these guys are going to want their money at the end of next month, normally on 30 days. So 3,000 Rand over there. Right. Then we've got business debtor, client A, and he's got a debit balance. So that means there's work that I've done for the client. Because I've done work for him, he owes me money. So is that an expense when he pays me? Will I have to give it back to him? Or is it an asset? It's money that will in future come in. The answer is it's an asset. In future, my client will pay me. Now again, if you tell your client, listen, I'll do the job for you, but you only have to pay me next year, you can show it there. But in this case, we want our client to pay us next month. So business debtor, client A is a current asset. We hope that he will pay us in the next month or two. Then I've got UOF and PAYE owed to SARS. So this means it's a credit balance, it's a liability, or it's income. So what is that? That's the amounts that I've deducted off the salaries of my employees, the UIF and the PAYE, on the 25th of this month. But now I need to pay that over to SARS by the 7th of the next month. So I need to show that in future, although it's only 7 days later, it counts as the future, I'm going to have to pay UIF and PAYE to SARS of 960 Rand. Right, now we've accounted for everything on our trial balance. So we've got all of our assets, non-current assets, current assets. We've got liabilities, non-current liabilities, and now current liabilities. Okay, but there's a problem. I've ran a formula here to say total assets, because remember the formula that we started with right in the beginning, assets equals equity plus liabilities. So I've got a problem. I've got a mismatch here of 13,000 Rand. Where does that come from? And the answer is, remember, what did I say? Our income statement for the year, the balance of my income statement needs to carry over as my retained earnings. So if I take retained earnings, I link that to the income statement, and suddenly my balance sheet balances. So this is ultimately where we want to work to from the accounting records. So from our historic accounting records, this is what we want to work towards a balance sheet and an income statement. So now if I go to you and I say, what was the turnover for your law firm for the year? It's very simple. There's my income. We've turned 50,000 rand. If I now ask, what was your profitability or what was your profit for the year? Then you can come here, one amount, there's 13,000 rand. If I tell you how much do you have in short-term assets available, then you can simply come here and say, okay, in current assets is 21,000, but I need to pay out 8,000, so I've got, give or take, 12,000 rand available as spending money at the moment. So do you see how, if I had to ask you those questions from the information in my trial balance, that would be very difficult to work out. But in this format, we can very easily answer questions about our business and see whether we made money or not, and whether our business is liquid or not. And then in the next lecture, so this information up to this date has all been received from or accounted from historic records. So it's all transactions that has already happened that get us to this point. And then in the next lecture, we're going to look at budget and cash flow forecasts. So then we'll take this and we'll say, let's use the information that we had historically about our business and plot that against the future and budget and see whether we'll be able to make some monies in the future. Okay, that's our lecture on financial statements. So as explained, this is not necessarily something that you guys will have to be able to draft yourself. If you do your own accounting, yeah, you will have to do this to keep compliant with SARS, but most probably you'll have accountants that will get you up to this point. But definitely there will be some value in it to be able to analyze this and gain some more information about your business. Right, so the next recording will then be about budgets and cash flows.